A lot has been in the news lately around Biden's most recent tax change proposals, and many of these changes directly target the real estate industry, specifically larger commercial real estate investments and the investors that buy and operate larger apartment buildings, retail shopping centers, office buildings, and industrial warehouses. And while none of this has turned into law just yet, if some or all of these measures do go into effect, it's very likely that we're going to see some pretty significant impacts to the commercial real estate industry, both in the short and long term. So in this video, what we'll do is break down what the most impactful of these proposed changes are to the commercial real estate industry, specifically how these changes might affect transaction volume and property pricing over the next few months, and the potential long-term impact of all of these changes on real estate as a whole. So if you haven't been reading the news lately, the Biden administration has proposed some pretty major tax changes to attempt to pay for the trillions of dollars of stimulus packages that have been passed over the last 12 months. And unfortunately for the real estate industry, many of these changes directly target real estate investors, both active owners and operators of commercial real estate properties and commercial real estate investment firms, as well as passive investors in commercial real estate syndications and funds. And tax law tends to incentivize behavior, meaning that significant changes to the way real estate investments are taxed could also lead to some major changes in behavior among real estate investors, which inevitably affects property values, pricing, and how commercial real estate is bought and sold overall. So in this video, let's break these changes down by walking through three of the most impactful issues at stake under these new proposals and the impact that each might have on the industry going forward. So the first issue, and most directly targeted at the real estate industry specifically, is the proposed elimination of the 1031 exchange for real estate capital gains greater than $500,000. The 1031 exchange rule currently allows real estate investors to sell a property and defer capital gains taxes by purchasing a replacement property of equal or greater value, incentivizing investors who have created value in their projects to move on to a new deal and repeat the process without having to pay taxes on that value that they've created. The 1031 exchange has been around for an entire century at this point, and with that, an entire ecosystem of companies has been built up with 1031 exchange related services as their main business activity. Between qualified intermediaries, investment firms offering Delaware Statutory Trust or DST investments, and brokerage firms that see a significant amount of business from 1031 buyers and sellers, excluding gains of over $500,000 from the current 1031 exchange rules would have a material immediate effect on a significant portion of the commercial real estate industry as it stands today. About 12% of all real estate sales were part of a 1031 exchange from 2016 to 2019, according to a 2020 survey from the National Association of Realtors, and 84% of those exchanges were performed by sole proprietorships or S corporations, not just the big behemoth private equity firms that many people believed would be the hardest hit with a change to this policy. This would also likely create an unintended trickle-down effect to make the housing shortage we're seeing in the US even more severe than it is today, with 1031 exchange sellers often being longtime owners of properties with significant capital needs that are usually taken care of by the next owner of the deal. Residential real estate investors tend to go into an acquisition looking for new renovation opportunities, the ability to add units to an existing building, or a mixture of both. And if those would-be sellers can't take advantage of a 1031 exchange anymore and end up being subject to capital gains taxes upon sale, fewer of these properties are likely going to come to the market in the first place, and the capital improvements or additional housing units that a new buyer would have added to these properties won't end up materializing at all. Now, the 1031 exchange going away would be a big hit for real estate investors, but this is an even more pressing issue today because of the number 2 point on this list, which is the proposal to increase the federal capital gains tax rate from 20% to 39.6% on those people with incomes of over $1 million per year. Property values have increased dramatically over the past 2 decades, up by almost 230% since April of 2001, meaning that even a small-time individual investor who put 20% down on an $800,000 property 20 years ago would very likely have a gain of $1 million or more if they were to sell their property today, putting them in a federal capital gains tax bracket of almost 40% on what could very well be a significant portion of their total net worth. And this is on top of a net investment income tax of 3.8% for married couples earning more than $250,000 per year, plus any additional state taxes, which would amount to a total tax burden for capital gains of over 50% in high income tax states like California, Hawaii, New Jersey, Oregon, and New York. All of these things together point towards significantly reduced transaction volume in the long term if this is passed, reducing the overall revenue generated by all parties associated with a real estate transaction as a result, and state and local governmental agencies are included in that mix. And finally, to rub salt into the wound for the real estate industry, the final issue on this list that would already be happening on most deals if the capital gains tax is increased is the proposal to change the taxation of carried interest from being treated as a capital gain to being subject to ordinary income tax rates. We've talked about carried interest or the promote on this channel before, but in case you're not familiar with this term, this is essentially the sweat equity earned by general partners on real estate syndications and funds that allows them to receive a disproportionate amount of the profits on a deal in relation to the equity they've invested after exceeding return hurdles set by their limited capital partners. Now, like I mentioned, if capital gains tax rates double for high income earners, carried interest on most mid-sized to larger deals would likely be subject to the 39.6% income tax anyway, regardless of whether or not this passes. But on its own, this could have a significant impact on real estate investment firms who rely on promoted interest checks to help fund their operations and to reinvest in their business. For smaller firms, which make up a major portion of the real estate ecosystem across the US, an additional $200,000 to $1 million in taxes or more on a $1 million to $5 million gain makes a material impact and reduces the money they're able to spend to hire new employees, invest in new technologies, and ultimately do the things necessary to grow their companies. At the end of the day, these are all pretty big changes, and as I mentioned in the beginning of this video, big changes to tax policy can lead to big changes in behavior among investors. So with that said, and these three policies outlined, here are the impacts I think these measures could have on the commercial real estate industry if they're passed, and how these might affect real estate professionals and investment firms in the short and long term. So first, if these changes were to pass into law and they were to take effect in 2022 or 2023, this could lead to an accelerated sell-off in commercial real estate properties over the next 6 to 18 months. A 6 or even 7-figure tax hike is a significant hit for many smaller real estate investors and investment firms, so it wouldn't surprise me to see a big uptick in active listings towards the end of this year or into next year to take advantage of the current tax laws, depending on when these changes would go into effect. This flood of new supply into the market could potentially drive cap rates up and property values down in the short term, creating the potential for a short-lived buyer's market for many commercial real estate product types that we haven't seen in a while, even in the hottest asset classes like industrial and multifamily. However, in the long term, if these changes do end up taking effect, this is where I think things could start to look pretty dramatically different as we head into a post-tax reform era in commercial real estate with more punitive capital gains taxes that can't be deferred. If the 1031 exchange goes away, carried interest becomes taxed as ordinary income, and the capital gains tax rate jumps to 39.6% for earners making over $1 million per year. The biggest threat to the commercial real estate industry from this, in my opinion, is a dramatic decrease in overall transaction volume. If you think about a basic example of an investor in their 70s who bought a 24-unit apartment building for $1 million 10 years ago, and that property has appreciated to $2 million today, under the in-place rules, that investor could sell the property and buy a more hands-off deal through a 1031 exchange and pay nothing in capital gains taxes today, and potentially even pass on that new property at a stepped-up cost basis to his heirs when he passes. Even if he wanted to sell his property and wipe his hands clean of real estate ownership overall, he would know that his federal capital gains tax liability would cap out at the current 20% rate, and both of these situations can help incentivize a property owner to sell their property and transact as long as the price is right. But under the new guidelines, assuming each of these measures pass, that investor would take a massive tax hit in any scenario if they decided to sell. And if that investor were lucky enough to live in a state like California, they could be looking at a tax bill of over $560,000 when they ultimately sell the asset. And with a tax bill like that, an investor is incredibly disincentivized to sell, even at an attractive offer price. And this leads to less transaction-related revenue going to all third parties associated with real estate deals, like brokers, attorneys, and title and escrow companies, as well as state and local agencies that make money on property sales through things like transfer taxes and recording fees. This ends up being an even bigger hit to states like California that only reassess property values for tax purposes upon sale of the property, since fewer transactions equal fewer reassessments, meaning that many longtime holders of commercial real estate could be drastically underpaying property taxes in comparison to the current market value of their property. Ultimately, in commercial real estate, money is made through transactions, and the less incentivized property owners are to transact, the worse off the entire real estate industry is overall. And at the end of the day, none of this has passed into law just yet, so as of right now, these are just proposals, many of which have been raised before. There's no guarantee that these go into effect, and even if they do, there will likely be some tweaks and changes that move things a little bit closer to the middle and make these changes less dramatic across the board. But in case you're wondering how this might affect you if you currently own commercial real estate, or if you're trying to land a job in the industry and you're reliant on transaction volume to make your living, I hope this was helpful as a general overview of how these proposals might change the commercial real estate landscape and the impacts these initiatives could have. As always, guys, if you like this video and want to see more content like this around current events on this channel, make sure to hit the like button to let me know, and let me know in the comments what kind of an impact you think these changes might have on the real estate industry going forward. Thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.